You're watching this because something has shifted, not just in price charts or market headlines, but in the fundamental architecture that holds the global financial system together. And if you hold silver, gold, or have been watching metals and commodities with any degree of seriousness, what's happening right now deserves your full attention. This isn't about predicting the next big move. It's not about telling you what will happen tomorrow or next week. This is about understanding what has already changed, why that change matters, and how thinking investors navigate moments like this without losing their discipline or their capital. Let me be direct with you. The precious metals market, and particularly silver, is sitting at a junction that we haven't seen in over a decade. The signals are not subtle, the macro environment is not ambiguous, and yet most commentary you'll find right now is either pure hype designed to generate clicks or dismissive noise from those who haven't been paying attention to what central banks, governments, and major institutions have been doing quietly in the background. I'm speaking to you today as someone who has watched multiple market cycles unfold. I've seen the euphoria, the crashes, the recoveries, and the long grinding periods where nothing seems to happen. What I'm going to share with you is not a prediction. It's an assessment based on observable facts, historical patterns, and the kind of macroeconomic pressure that tends to reshape how capital flows across the entire system. If you already own silver, you need to understand what this moment means for your position. If you don't own any, you need to understand what you might be missing, but also what mistakes you absolutely must avoid. And whether you own metals or not, you need to understand what's happening in the broader commodity space, because copper and gold are telling their own stories right now. Those stories are connected. This is a long conversation, but it's an important one. So let's begin where we need to begin, with what has actually changed. Over the past 18 months, something fundamental has shifted in how the world's largest economies are managing their debt, their currencies, and their exposure to risk. It's not dramatic in the way a stock market crash is dramatic. It's structural, it's quiet, and it's accelerating. Central banks that spent the better part of 2 decades selling gold reserves have reversed course, not just slowing their sales, but actively accumulating. The scale of this accumulation is significant. We're talking about hundreds of tons being purchased by institutions that set monetary policy for billions of people. When central banks change behavior at this scale, it's not because they're speculating, it's because they're rebalancing for a future they see coming. At the same time, government debt levels have crossed thresholds that were once considered unsustainable. But here's what matters. They're not slowing down. Fiscal deficits are widening, not narrowing. Interest payments on existing debt are consuming larger and larger portions of tax revenue. And the political will to cut spending or raise taxes significantly simply does not exist in any major economy. This creates a condition that economists call fiscal dominance. It's the point where monetary policy becomes subordinated to the needs of government financing. In plain language, it means central banks have less and less room to fight inflation with traditional tools, because raising rates too much would blow up government budgets and potentially trigger a debt crisis. Now, layer on top of this the monetary response to recent banking stress. We saw emergency liquidity measures deployed rapidly. We saw deposit guarantees expanded beyond their legal limits. We saw the implicit message delivered loudly: the system will not be allowed to contract in a meaningful way, no matter what the stated policy is. What does this have to do with silver? Everything. Because silver sits at a unique intersection. It's a monetary metal with thousands of years of history as money, but it's also an industrial commodity, increasingly critical to the energy transition, to electronics, to solar panels, to the electrification of transportation. This dual nature means silver responds to both monetary stress and industrial demand simultaneously. And right now, both of those forces are intensifying. The biggest mistake people make when thinking about silver is treating it like a stock. They look at short-term price movements and make judgments about whether it's working or not. They get frustrated during long consolidation periods. They chase momentum during rallies and panic during corrections. But silver doesn't work like that. It never has. Silver moves in long cycles that can span years, even decades. It consolidates for extended periods while fundamentals build in the background. Then it moves violently, catching most people completely off guard. The people who understand this don't try to trade every wiggle. They position themselves during the quiet periods and hold through the volatility. Another common misunderstanding is treating silver as a pure speculation. Yes, there's speculative interest in silver, but the core case for holding it has nothing to do with speculation. It's about what happens to paper currencies over long time horizons when governments face impossible fiscal mathematics. It's about what happens to industrial commodities when genuine physical shortages develop in thin markets. The ratio between gold and silver has been watched by metals investors for generations. Historically, that ratio has averaged somewhere between 15 to 1 and 60 to 1, depending on the era and market conditions. In recent years, that ratio spiked to over 120 to 1 during extreme stress events, then contracted sharply. Right now, we're in a zone where silver is historically cheap relative to gold. That doesn't mean it has to correct tomorrow, but it does mean the relative value proposition has rarely been more compelling. Most people also misunderstand the supply dynamics. They hear that silver is mined all over the world and assume supply is abundant, but most silver comes as a byproduct of mining other metals, primarily copper, lead, and zinc. You can't just produce more silver by opening more silver mines. The economics don't work that way. And when industrial demand rises faster than byproduct supply, the market can tighten much faster than people expect. Finally, there's a fundamental misunderstanding about what price discovery means in the silver market. The vast majority of silver trading happens in paper markets, in futures contracts, and derivatives that are settled in cash, not metal. The physical market is much smaller and much less liquid than people realize. When physical demand surges and the paper market gets tested, strange things can happen. We've seen glimpses of this before. We may be about to see it again. Let's talk about what happens when monetary systems come under stress. Not theory, but history. Actual patterns that have repeated across different countries, different eras, different political systems. When governments spend far beyond their means and monetize their debt, purchasing power gets redistributed. It doesn't happen overnight. It happens gradually, then suddenly. The people who hold hard assets, assets that cannot be printed or created by decree, tend to preserve wealth. The people who hold only paper promises tend to lose it. This isn't ideology. It's just mathematics. If you create more units of currency but don't create more goods and services in proportion, each unit becomes worth less. The question is never whether this happens. The question is how fast it happens and who sees it coming. Look at the 1970s. Inflation didn't appear instantly. It built over years. Policymakers insisted it was transitory. They blamed oil shocks and supply disruptions. But the underlying cause was straightforward. Too much money creation relative to economic output, combined with government debt that kept expanding. What happened to gold and silver during that decade? They multiplied many times over, not because of speculation, but because they became the assets people bought to preserve purchasing power when paper currencies were failing that function. Look at what happened after the 2008 financial crisis. Massive monetary expansion, historic stimulus programs, a decade of near zero interest rates. And what happened to precious metals in the years that followed? They rallied significantly, paused during a multi-year consolidation while the world digested that expansion, then began moving higher again as the fiscal situation deteriorated further. We're now in a period where the monetary expansion has been even larger. The fiscal deficits are even wider. The debt levels are even higher. And the structural problems are even more deeply embedded. History doesn't repeat exactly, but it often rhymes. The patterns are there for those willing to look without bias. Here's something else history teaches us. The metals don't move in a straight line. They consolidate, frustrate, bore investors for long periods. Then they move fast, really fast. The people who do well are the ones who position themselves during the boring periods, not the ones who chase the moves after they've already started. Let's break down what's actually driving this moment. Not in technical jargon, but in clear terms that explain why we're here and where the pressure is building. First, inflation is not under control. Yes, headline numbers have come down from their peaks, but core inflation remains elevated. And more importantly, the public's expectation of future inflation has shifted. Once people start expecting prices to keep rising, their behavior changes. They buy sooner rather than later. They demand higher wages. They lose confidence in saving in paper currency. This becomes self-reinforcing. Central banks are caught in a trap of their own making. If they raise interest rates high enough to truly crush inflation, they risk triggering a recession, crashing asset markets, and making government debt unsustainable. If they don't raise rates enough, inflation becomes embedded and expectations become unanchored. There's no clean way out. So they're trying to thread a needle, hoping something changes that gets them off the hook. Meanwhile, government spending continues to accelerate, not just in one country, but across most major economies. Demographic pressures are intensifying. Populations are aging, which means more spending on pensions and healthcare, and fewer workers generating tax revenue. This is not a political problem with a political solution. It's a mathematical problem with no easy answer. The currency market is showing stress. Not crisis-level stress yet, but underlying tension. Faith in reserve currencies is being questioned in ways it wasn't a generation ago. Countries are exploring alternatives to dollar-denominated trade. Central banks are diversifying their reserves more aggressively. These are long-term shifts, not short-term trades. In the commodity space, we're seeing something unusual. Copper, which is often called Dr. Copper because of its economic sensitivity, has been showing strength despite concerns about global growth. Why? Because the physical demand story is overwhelming the cyclical concerns. Electrification requires enormous amounts of copper. Green energy infrastructure requires enormous amounts of copper. The supply side hasn't kept pace. Mines take a decade or more to develop. The deficit is structural. Silver faces a similar dynamic, but more extreme. Industrial demand is rising. Solar panel manufacturing has become a major source of demand. Electronics are becoming more silver intensive, not less, and supply growth is constrained because silver is mostly a byproduct. When primary metals like copper see underinvestment in new mines, silver supply suffers as a consequence. Understanding markets means understanding people. And right now, investor psychology around precious metals is in an interesting place. There's a generation of investors who have never experienced a real monetary crisis. They've grown up in a world where central banks always stepped in, where markets always recovered, where buying the dip always worked. Their experience has taught them that risk is an illusion, that volatility is just opportunity, that the system is stable. This creates a dangerous complacency, not because these investors are foolish, but because their experience is limited to a very specific period in history. They haven't seen what happens when the tools stop working, when the monetary medicine stops curing the disease, when confidence begins to crack. On the other hand, there's a smaller group of investors who have been expecting a crisis for so long that they've lost credibility, even with themselves. They've been buying metals for years, watching them go nowhere or down, feeling like the analysis is right, but the market is wrong. This creates a different kind of vulnerability, the tendency to sell right before the move finally happens, out of exhaustion and frustration. The smart money, the patient capital, doesn't think in terms of right or wrong. It thinks in terms of probability and position sizing. It understands that structural problems take time to manifest. It understands that markets can remain irrational longer than most people can remain solvent. So it builds positions gradually, manages risk carefully, and doesn't bet the farm on any single outcome. Right now, sentiment around silver is mixed. It's not at the euphoric extremes that mark tops. It's not at the despairing lows that mark major bottoms. It's in that awkward middle ground where some people are bullish, some are bearish, and most are just confused. This is actually a productive environment for accumulation if you know what you're doing. What we're seeing in the gold market is worth noting. Gold has been making new highs in multiple currencies, even as mainstream financial media barely covers it. This is unusual. Typically, gold rallies are accompanied by lots of attention and fear. This rally has been quiet, steady, driven more by institutional buying than retail speculation. That's a healthier foundation than euphoria-driven moves. Silver tends to lag gold in the early stages of a metals bull market. It consolidates while gold establishes new ranges. Then, when the move becomes more obvious and more investors pile in, silver tends to outperform dramatically because of its smaller market size and higher volatility. We may be in that early phase now, or we may not. No one can know for certain. But the pattern is worth understanding. If you've been holding silver for any length of time, you know it requires patience. You've probably experienced periods where it felt like a mistake, where the price went nowhere while other assets rallied, where the fundamentals seemed strong but the market didn't care. This is the nature of the asset. It's not designed to deliver steady, predictable returns like a dividend stock or a bond. It's designed to preserve purchasing power over very long time periods and to provide explosive upside during monetary crises or supply crunches. The trade-off is that you have to endure long periods of apparent dead money. What you need to understand now is that the macro environment is evolving in ways that typically precede major moves in silver. Not guarantees, but probabilities shifting in your favor. The fiscal pressures are real. The monetary distortions are real. The supply constraints are real. The industrial demand growth is real. This doesn't mean you should become complacent. It doesn't mean you should ignore risk management or position sizing. It means you should understand why you hold the asset and what conditions would cause you to change your view. If you hold silver as a long-term store of value, as insurance against monetary instability, then short-term price movements shouldn't change your thesis unless the underlying fundamentals change. Are governments getting their fiscal houses in order? Are central banks shrinking their balance sheets aggressively? Are debt levels falling? Is the currency system becoming more stable? If the answer to these questions is no, then your reason for holding hasn't changed. If you hold silver with the expectation of industrial demand growth driving prices higher, then you should be monitoring supply and demand dynamics. Are inventories rising or falling? Are premiums for physical metal expanding or contracting? Are major industrial users securing long-term supply contracts at higher prices? These are the signals that matter, not daily price action. One thing to consider, if silver does move significantly higher, will you know when to take profits? Or will you ride it all the way up and all the way back down? Many precious metals investors have made this mistake before. They wait years for a move, it finally happens, and they convince themselves it's going to infinity. Then they give back all the gains. Think about your strategy now while emotions aren't running high. What would constitute success for you? Is it a certain multiple on your investment? Is it reaching a specific financial goal? Is it simply preserving wealth through an uncertain period? Having clarity on this will help you make better decisions when the time comes. If you're watching this and you don't currently own any silver, you're probably wondering whether you've missed the opportunity or whether there's still time to get involved. Let me be clear about this. First, no one can tell you definitively whether the next move is up or down in the short term. Anyone who claims otherwise is either lying or delusional. What we can assess is whether the risk-reward proposition makes sense over a multi-year horizon, given what we know about monetary policy, fiscal deficits, supply dynamics, and industrial demand trends. Second, the worst thing you can do is rush into a position because you're afraid of missing out. Fear of missing out is one of the most destructive emotions in investing. It causes people to buy at tops, to oversize positions, to skip due diligence, to ignore risk management. If you're going to allocate capital to silver, do it thoughtfully, not reactively. Here's what you should be thinking about. Why would you want exposure to silver? Is it because you believe the monetary system is unstable? Is it because you see the industrial demand story as compelling? Is it because you want portfolio diversification away from paper assets? Different reasons might lead to different position sizes and different timeframes. If you don't understand why you're buying, you won't know when to sell. You won't know how to size the position. You won't know what signals to watch. You'll just be gambling based on someone else's conviction, which is a recipe for losing money and emotional stress. Let's talk about position sizing. Precious metals, including silver, are volatile. They can swing dramatically in both directions. The people who get hurt are the ones who bet too much. A reasonable allocation for most investors might be somewhere between 5 and 15% of investable assets, depending on your situation, your risk tolerance, and your conviction level. This is not financial advice specific to you, but a general framework that has worked for disciplined investors over time. If you decide to build a position, consider doing it gradually. Dollar cost averaging into silver over several months or even a year can reduce the risk of buying at a local top. It also gives you time to learn about the asset, to understand how it trades, to develop conviction without betting the farm all at once. Also understand that silver is not a short-term trade for most people. If you need the money in 6 months or a year, silver is probably not the right place for it. Silver requires patience. It requires the ability to ignore short-term volatility. It requires the emotional discipline to hold through drawdowns that might test your conviction. Silver doesn't exist in isolation. Understanding what's happening with gold and copper helps you understand the broader environment that silver is operating within. Gold is the monetary metal that central banks and institutional investors turn to first when they lose confidence in paper currencies or face geopolitical risk. Gold has been performing extremely well relative to most other assets. It's making new highs in many currencies, even as real interest rates have risen, which is unusual. Typically, gold struggles when real interest rates rise because the opportunity cost of holding a non-yielding asset increases. The fact that gold is performing well despite higher rates tells you something important. There's underlying demand that's overwhelming the traditional negative factors. That demand is coming from central banks, from Eastern economies, diversifying away from dollar assets, from institutional investors seeking portfolio insurance, and from individuals in countries experiencing currency instability. When gold performs well, it creates a halo effect for silver. Investors who are attracted to precious metals for monetary reasons typically start with gold because it's more liquid and less volatile. But as their conviction grows, many of them allocate to silver as well, viewing it as a leveraged play on the same themes that drive gold, plus the industrial demand component. Copper is telling a different but related story. Copper is not a monetary metal. It's a pure industrial commodity. The fact that copper is showing strength tells you that the physical economy, despite all the concerns about recession and slowdown, is still consuming massive amounts of raw materials. The green energy transition is real, not just rhetoric. The electrification of transportation is happening. The infrastructure build-out in developing economies continues. This matters for silver because silver has industrial applications that overlap with the same trends driving copper demand. Solar panels use silver, electric vehicles use silver, 5G infrastructure uses silver. As these sectors grow, they pull more silver out of available supply. And unlike copper, silver doesn't have dedicated mines that can rapidly expand production when price rises. The supply response is much slower and much less elastic. Now let me talk about what you should absolutely not do, regardless of whether you own silver or not. These mistakes destroy capital and cause unnecessary emotional pain. Do not react to short-term price movements with emotional decisions. Silver can drop 10 or 15% in a matter of days, then recover just as quickly. If you panic sell during those drops, you lock in losses right before potential recoveries. If you panic buy during surges, you often end up buying at temporary tops. Emotional trading is the enemy of successful investing in volatile assets. Do not over-leverage. Do not buy silver with borrowed money. Do not use margin. Do not bet money you need for living expenses or financial obligations. The temptation when you have strong conviction is to maximize your exposure through leverage. This is how people blow up their accounts. Silver is volatile enough without adding leverage to the equation. Own it outright, or don't own it at all. Do not blindly follow online hype or social media speculation. The internet is filled with people making extreme predictions about silver going to triple digits or higher in short time frames. Some of these people have good intentions but poor analytical skills. Others are actively trying to manipulate sentiment for their own benefit. Your investment decisions should be based on your own research, your own understanding, your own assessment of risk and reward. Do not ignore the rest of your financial life. Silver, or precious metals generally, should be part of a diversified approach to wealth building and protection. They shouldn't be your entire strategy. You still need emergency savings. You still need to manage debt. You still need to think about income and cash flow and all the other aspects of financial health. Getting obsessed with one asset class to the exclusion of everything else is dangerous. Do not assume that past performance guarantees future results. Yes, silver has had explosive rallies in the past. Yes, it has multiplied in value during previous monetary crises, but every cycle is different. The conditions are different. The market structure is different. The participants are different. Study history for patterns and probabilities, not blueprints. Do not treat silver as a get-rich-quick scheme. The people who do well with precious metals are patient. They accumulate during quiet periods. They hold through volatility. They take profits gradually when opportunities arise. They think in years and decades, not weeks and months. If you're looking to double your money in 6 months, silver is not the right place for you. Go find something else, preferably something you fully understand the risks of. Finally, do not stop learning. Markets evolve, conditions change, new information becomes available. The investors who do best over long periods are the ones who remain curious, who update their views when facts change, who admit when they're wrong and adjust accordingly. Stubbornness and ideology are expensive in financial markets. Let me bring this all together by offering you a framework for thinking about where we are right now and what it means for how you approach your financial decisions. We are in the late stages of a long-term debt cycle. This is not controversial. This is observable fact, acknowledged by central bankers, by economists across the political spectrum, by institutional investors. Debt levels, as a percentage of GDP, are at or near historic highs in most developed countries. The demographic trends that would allow us to grow our way out of this debt are unfavorable. The political will to cut spending or raise taxes significantly does not exist. This means we're likely to see some combination of financial repression, inflation, currency devaluation, and occasional bouts of acute stress in credit markets. This is not a prediction of immediate collapse. It's a recognition that the path forward for governments is to make their debts more manageable by reducing their real value, which happens through inflation and currency depreciation. In this environment, assets that hold their value independent of government policy become more valuable. Real estate, productive businesses, commodities, precious metals, these are the types of assets that tend to preserve purchasing power when paper currencies lose it. The exact mix that's right for you depends on your circumstances, but having some exposure to this category makes sense for most people. Silver represents one option within that category. It combines monetary properties with industrial utility. It's volatile, which means risk, but also opportunity. It's historically undervalued relative to gold by many measures. It's facing supply constraints, just as industrial demand is accelerating. These factors don't guarantee profit, but they shift the probability distribution in a favorable direction. The key is to position yourself in a way that allows you to benefit if the thesis plays out, but doesn't devastate you if it doesn't, or if it takes much longer than expected. This means appropriate position sizing. It means holding the physical metal or highly liquid ETFs, not exotic derivatives you don't fully understand. It means having a time horizon of years, not months. It means staying informed, but not obsessed. Remember that markets are humbling. The smartest people in the world get things wrong regularly. The person who claims to know exactly what will happen and when is either ignorant or dishonest. What we can do is assess probabilities, manage risk, position ourselves to benefit from likely scenarios while protecting against unlikely but painful ones. This is not a time for complacency, but it's also not a time for panic. It's a time for thoughtfulness, for education, for careful preparation. The investors who will do well in the next decade are the ones who understand the macro environment clearly, who position themselves accordingly, and who have the discipline to hold through inevitable periods of volatility and doubt. If you've stayed with me through this entire conversation, you understand that what we're discussing is not simple. It's not about buying a ticker symbol and watching it go up. It's about understanding the forces that shape how value moves through the financial system over long periods of time. Silver, gold, copper, these are not just commodities or trading vehicles. They're real assets with thousands of years of history, with industrial applications, with monetary properties that become relevant when paper currencies face stress. Understanding them requires understanding economics, understanding history, understanding human psychology, and understanding yourself. What I want you to take away from this is not a prediction about where silver is going next week or next month. What I want you to take away is a framework for thinking about why these assets matter, what conditions make them more or less attractive, and how to approach them with discipline rather than emotion. If you already hold silver, I hope this gives you renewed confidence in why you own it and what to watch for going forward. If you don't own any, I hope this helps you decide whether it makes sense for you, and if so, how to approach it intelligently. The macro environment is changing, not in ways that are dramatic and obvious, but in ways that are structural and profound. Governments have more debt than they can realistically service without inflating it away. Central banks have less room to maneuver than they did in previous cycles. The physical commodity markets are tighter than the financial markets reflect. Industrial demand for critical materials is accelerating just as supply growth is constrained. These are the conditions that historically create significant opportunities for investors who position themselves thoughtfully, early, and with appropriate risk management. They're also the conditions that can trap and hurt investors who chase performance, over-leverage, or make emotional decisions. Stay informed, stay disciplined, think in probabilities, not certainties. Size your positions appropriately. Have a plan for what you'll do if you're right, and a plan for what you'll do if you're wrong. Don't let fear or greed drive your decisions. Don't let short-term volatility shake you out of long-term positions that still make sense. The crisis we're facing is not a sudden shock that will arrive next Tuesday. It's a slow-motion unraveling of fiscal and monetary stability that has been building for decades and will continue to unfold over years to come. The investors who understand this, who prepare accordingly, and who maintain their composure while others panic or remain oblivious, those are the ones who will preserve and grow their wealth through what's coming. Thank you for your time and your attention. Keep learning, keep thinking, and make decisions based on understanding, not hype. The markets reward patience, discipline, and clear thinking over everything else.